Welcome to The Explainer. Today we're diving into something that feels, well, a little contradictory about Indian real estate. On one hand, you hear that homes have never been more affordable. But on the other, for so many people, owning a place of their own feels completely out of reach. So what's really going on? Let's get into it.
All right, let's just start with a really simple question that cuts right to the chase. Forget all the complicated financial jargon for a second. Just think about this. How many years of your entire salary, before taxes, before expenses, would you have to save up just to buy an average home? The answer, well, it really depends on where you live. To figure this out, we're going to use a simple but really powerful tool that all the experts use. It's called the price-to-income ratio, or PI for short, and it's exactly what it sounds like. It tells you how many years of your full income it would take to buy a house. And obviously, the lower that number is, the better.
So, what does this actually look like on the ground? Well, let's start with Mumbai, the country's financial engine. Here, the PI ratio is a staggering 34 years. Just let that sink in for a second. That's 3.5 decades of your entire paycheck just for one average-priced apartment.
Okay, what about the tech capital, Bengaluru? It's a similar story. You're looking at 22 years of income. For the average person trying to build a career there, that is a huge mountain to climb.
But here's where it starts to get really interesting. You go to a city like Ahmedabad, and that number suddenly drops to around 6 years. Now that's much closer to what financial planners would call a healthy, achievable goal. This massive difference between cities is our first real clue that there's a more complicated story unfolding here.
And that brings us to the heart of this paradox. Because despite those incredibly high numbers we just saw, the official story, the one you see in reports, is that housing in India is actually getting more affordable. How on earth can that be true?
Well, if you zoom out and look at the national average, the picture flips completely on its head. The average price-to-income ratio across all of India has been nearly cut in half since 2010. I mean, on paper, this looks fantastic, right? It suggests incomes are rising way faster than home prices.
And this is the kind of data that you see making headlines. A major real estate report recently made a big deal about this milestone. Even in crazy expensive Mumbai, the average monthly home loan payment finally dipped below that 50% stress threshold. So the narrative is that things are getting better.
So, what is going on here? How can both of these things be true at the same time? How can a home in Mumbai cost 34 years of your salary while we're also being told it's more affordable than ever? This is the paradox we need to crack open. And the answer, it turns out, is that we're not really talking about one single India. The data is telling a story of two very different Indias, with two completely separate economic realities, all happening at once.
And you can see exactly how the market is responding to those two realities right here. Just look at what's being built. Developers are pouring their resources into high-end, premium, and luxury homes, because that's where the money is. Meanwhile, the supply of what's called affordable housing has shrunk to a 7-year low.
So here's the catch. This is the real reason that national affordability number is so misleading. The improvement we see in the averages is almost entirely driven by the soaring incomes of the top 5%. Their earnings pull the whole average up. But for the other 95%, whose wages haven't kept up with property prices, it's a totally different story. Think about it. To get a loan for a pretty typical 50 lakh rupee home, you need to be making around $90,000 a month. The average urban salary, it's closer to $25,000. That's a huge disconnect.
Okay, so that's the picture inside India. But is this kind of a situation unique? Let's zoom out one more time and see how this stacks up on the world stage. If we put India right next to, say, the US, the difference is pretty stark. The average price-to-income ratio in the States is about 5 to 6 years. In major Indian cities, it's easily double or even triple that. It just means that for an average citizen, buying a home is statistically way more within reach in the US relative to what they earn. And this chart. Wow, this really puts it all into perspective. Mumbai's ratio of 34 just towers over even San Jose, the heart of Silicon Valley and one of America's priciest cities. We are talking about a challenge that is on a completely different scale.
So all of this brings us to the big practical question for anybody who's actually trying to make a decision in this market. With these huge costs, does it even make financial sense to try and buy a home in India today?
So what's the smarter move, renting or buying? Well, it really boils down to a pretty clear trade-off. Renting is almost always going to be cheaper on a month-to-month basis, no question. But buying a home in India has historically been an incredible way to build wealth. Property values have tended to grow by about 9 to 11% a year, which consistently beats inflation.
So what about the break-even point?
When does buying start to make more sense than renting? Well, for most people in a major Indian city, the math usually shows that after about 5 to 10 years of owning, the equity you've built up and the rising value of your home makes it the better financial choice. It's a long-term play, for sure.
And so, where does all of this leave us? We're left with a really important final question. As India's cities continue to boom, is that classic dream of owning your own home becoming a thing of the past? A luxury that's only reserved for the wealthiest? The data suggests we're at a critical moment, and the answer to that is going to define the future for millions and millions of people.